My name is Caoilfhionn van der Walt. I'm an international tax partner at Regan van Roy. We are a specialist international tax and structuring firm. And today we want to cover structuring issues relevant to South African startups. So I am going to share my slides now in a moment. I would like this to be a fairly interactive session if possible. It is quite a dry topic, many say. So please feel free to come in with questions at any point, either raise your hand or put a comment in the chat. And then as we go through, we can deal with issues. We'll also have questions at the end. So here we go. This is what we're covering today. It's somewhat optimistically titled Tax and IP Structuring 101, a primer for South African startups. So in a nutshell, this is all you need to know about international tax and structuring if you're a startup. So what we're going to cover today, I don't know why my slide isn't working. Yes, so here's what we're going to cover today. First of all, should startups really think about an international structure? Secondly, what does a structure mean anyway? A lot of people talk about we have to structure, we need to structure, we shouldn't structure. What do we mean when we talk about that? Next question is, what is a good structure? What can be achieved if we structure correctly? The next one, which might be relevant to a lot of you, is how should a typical startup structure its business? Now, there's no such thing as a one size fits all, but we try to look at, in general, what would make sense for a startup to structure. Then we look at what can go wrong. Then we ask, when should I structure? So what is the right juncture at which a startup should consider setting up an international structure? Next one, how much does it cost? And after that, next steps. So we're going to try and cover all of these topics today. As I say, any questions as we go through, please put it in the chat or raise your hand. It can make the discussion more interactive if we talk as we go. So should startups really think about structure? Over the last couple of years, we've been doing a lot of work with South African startups, and most of them are ripe for structure. Now, not everyone should think about internationalizing your structure. And if, for instance, your startup is a business that, let's say, provides cleaning services to South African houses with South African cleaning staff, there's not much you can ever do in terms of an international structure. But it is worth looking at an international structure if you have lots of non-South African clients, if you have some staff that are not based in South Africa, or you have some key staff who are planning to move somewhere else, if you have IP or you think you're going to have significant IP, or if you want to be acquired by a non-South African resident. And a lot of the startups we talk to are in this phase. So especially people who are doing any sort of online service, whether it be software or marketing, typically they use the low-cost resources in South Africa to be more competitive globally, and they're looking at global clients, in which case it often is possible to set up a structure that optimizes their business. The question as to whether we should structure is always a cost-benefit analysis, and that is particularly true for startups who, often don't have a lot of cash on hand. A structure is an expensive thing to consider. It's expensive to get advice on a good structure. It is expensive to set up a structure. So it's always worth looking at what is the tax benefit I'm looking to reduce, what is the non-tax benefit I'm looking to achieve, and then weigh that up against the cost of doing the structuring work. What type of startup can best internationalize their structure? It really depends on what's happening in the business. When we look at whether a startup is suitable for international structuring or not, we typically look at the current and expected future location of three main things. The first one is, where are the shareholders and the main workers? And for a startup, typically the founders are the shareholders, are the main workers. So if they're currently living in Honolulu or intending to immigrate to New Zealand, that can be a very easy way to build a structure around their location. So that's the first question, where are the shareholders and the main workers? The second one is, where are your materials or suppliers? And often we think about, often the resources are the materials. So as I say, we've come across a lot of startups who use the high quality workforce in South Africa that's at relatively low cost, and that's the resource that they're using. And if the business is always going to be based on that, there will always be a strong presence in South Africa that we have to consider when we look at internationalizing the structure. And the most important one for us is, where are your customers? So if you as a startup have all your founders and main workers in South Africa, and you're using primarily South African resources or staff, and you intend to in future, and if most of your clients are South African, and in future you expect most of your clients to be South African, there is limited scope for structure. Now, one of the things I always say is that it's possible to do anything. So it is possible to structure, and it is possible to set up an international structure even for that type of scenario, and it is possible to get tax benefits. But typically the cost involved in setting it up and the risks that remain for it to be challenged would outweigh the potential benefit to be achieved. So we look at, where are the main people, where are the main resources, and most importantly, where are your customers? So again, if you have a significant chunk of non-South African customers, or you expect to have significant non-South African customers in future, it is worth looking at internationalizing your structure. So what do we mean when we talk about structure? Essentially, it means the legal structure, i.e. what companies are set up where. How are they held? Are they held directly or by trust? That's all it means. It looks at, what would the diagram, the group structure look like on a piece of paper? However, when we talk about structure, and certainly when we help our clients identify their optimal structure, we also think that it is critical to look at the transactional structure. So you can have a nice picture on a page with different boxes representing different entities in different jurisdictions, but it's critical to understand how they transact with each other. So what happens where and what is charged where. And the other thing that is critical to cover is a roadmap, which means how we get from where we are now to where we want to go. So if you have someone assisting you with your structure and all they give you is a picture with a couple of boxes in different locations, in our view, that is only half of the story. The other two important elements to consider are what each entity does, and to ensure that that is feasible commercially and is mitigating the tax risks that will exist with any international structure. And we have to understand, how do we get from where we are now to where we want to go? Typically, the big challenge with moving structure, and particularly in terms of internationalizing or externalizing a South African structure, is capital gains tax. And it's important that whatever structure you identify isn't punitively expensive because of capital gains tax. So why is structure important? Well, first of all, a good structure will limit your shareholder liability. A company was set up initially purely to separate the liability away from the shareholders. So the company has a liability that is limited away from the personal liability of the shareholders. And if you structure correctly, you can improve your shareholder liability situation, so basically de-risk for the shareholders more. A structure can also protect your operating assets and, very importantly, your intellectual property. So if we structure correctly, we can ensure that our operating assets are in a safe jurisdiction. Perhaps, especially from the IP side, you want them to be in a jurisdiction where, if you have to attack someone from an IP infringement perspective, that you've got a good legal system behind you. You might want to reduce country risk by putting valuable assets in owned by a country which, in your view, has a lower country risk. Linked to that, your structure can mitigate specific business risks and specific country risks. So an example of reducing country risk would be to have your assets owned in a country with a lower risk than the country that's utilizing the asset. A good structure can also support your long-term growth, support your strategic drivers and your operating model. So A lot of businesses have a very convoluted structure, which actually makes it more difficult to operate concisely. There's no point in having a structure that is not aligned with the way you actually do business. And it can be very damaging to have a structure that is not flexible, so is not able to cater for long-term growth, perhaps into other jurisdictions or different transactions that could arise. So it's important to have a flexible structure that is supportive of where you're intending to go in the future, in line with your strategy and linked to your operating model. A good structure will make it easier for you to raise funds and to obtain investors. Now, this is a big issue for South African businesses because we want to have a structure that will minimize our exposure to volatile currencies and enable us to obtain debt in hard currency or based on other balance sheets perhaps than we might have in South Africa. And many startups set themselves up with the intention of one day being sold. And typically they don't see themselves as being bought out by a South African entity. So it can be worth looking at what jurisdiction would it make sense to set up an entity in that would make it more attractive for the buyer that I imagine having. So as we said, currency possession is a big one, and that's linked to the raising of funds. If you're a South African entity, you're obliged to translate everything back to ZAR. Your results are in ZAR, and you're taxed on any exchange movements between that and perhaps the currencies you operate in. ZAR is obviously much more volatile than other currencies, so a correct structure can minimize your exposure to the South African rand and other soft currencies. We can also use a structure to mitigate our exchange control implications. Anyone who's operating in South Africa knows that it is very challenging to have to get SARB approval for every little thing. So the correct structure will ensure that your funds, for instance, roll up offshore so they can be deployed without needing exchange control approval. And of course, a good structure will optimize your overall tax position. This list is so long, and tax at the bottom of it, because we want to make it clear that a good structure is not all about tax. And if you only consider tax when you design your structure, you're missing out on other aspects, and you're more at risk of being challenged in terms of tax avoidance motives behind your structure. So any good structure will mitigate your specific business or country risk as much as possible, minimize any exchange control restrictions you're subject to, maximize your capacity to work in hard currency, make you more attractive in terms of funding or eventual sale, and optimize your overall tax. Now we dig into the tax a bit. So how can my structure optimize tax? Well, first of all, it's important to note that tax is not just corporate tax. So I was presenting at a webinar at the Tax Indaba a couple of weeks ago with a guy from SARS, and he was saying, well, why would anyone go to Mauritius when they're paying 28% tax in South Africa and 15% tax in Mauritius? It's only a 13% saving. And I was saying to him, it's not right to compare 28% to 15%, because in South Africa, we also have dividend withholding tax at a very high rate of 20%, whereas most countries that we would consider as a suitable jurisdiction for an offshore company don't have any withholding tax at all. So if you just look on the corporate level, it's essentially 45% being 28% plus 20% on that, compared to, let's say, 3% effective tax rate in Mauritius. So that's important. Your tax bill is not your corporate tax position only. You need to consider the holistic tax landscape. And this is particularly true for startups because the founders are usually also the shareholders. So we need to think about the corporate tax, but also their tax on the dividends and eventual sale. And they're usually also employees. So we need to think about dividend withholding tax, as we've said, very high in South Africa. Also employees tax, also high in South Africa at 45% on the top rate. Capital gains tax, which, as you know, is 18% for individuals, 22.4% for companies, very high. So if you're building a successful business from South Africa and want to sell it, you're going to have a significant CGT bill on that. And other withholding taxes also need to be covered. And that's, of course, in addition to indirect tax and customs. So remember, we're not simply talking about 28% tax to be saved. We have to think about the tax back to the shareholders. And the big issue there is 20% dividend withholding tax, which applies in South Africa. So looking at this in the numbers, if you run your business from South Africa, your business will essentially be taxed at 28% plus 20% dividend withholding tax. Now that's if you own, that applies whether you own your business directly as an individual or through a South African trust or through a South African company. There is no way around that 20% withholding tax. You are also taxed on all your revenues, whether arising from South Africa or not. So even if the bulk of your revenues actually come from US customers and you do a lot of the work outside of the country, if that is delivered by a South African vehicle, the entire amount is subject to tax in South Africa. If you sell your business, you are fully taxed on the South African gain, and all your IP is permanently in South Africa for both tax and exchange control purposes. So this is what we're trying to structure around from a tax perspective. So a good structure essentially will identify specific functions which we can put outside of South Africa. And what we focus on is high value, low personnel functions. So what we try to find is what can we move outside of South Africa that will be easy to move, but that doesn't require a lot of people to move. So we want to be able to justify significant profits offshore without having to move the entire business offshore. So how should a startup typically structure? Well, what we want to do is to find an offshore company in a safe jurisdiction. Now, what type of jurisdiction do we want? We want one, obviously, with no exchange control, because we don't want to have to be getting approval for every little piece we want to pay out of the country. We want it to be one where we can work in hard currency and where we have good access to funding, and that would be attractive for an eventual buyer to enter via. We obviously wanted to have a low corporate tax rate. We wanted to have no tax on dividend receipts. We would like it to have minimal capital gains tax and minimal withholding tax. So basically, we're looking for a landing pad where we can roll up our funds in hard currency, paying minimal tax and suffering minimal tax on payments in and payments out of that country. And then what we typically do is use this offshore company for all our non-South African revenue streams, all our non-South African functions, and to house our IP. We can also use it to hold any non-South African subsidiaries. And now, given the abolition of the restriction on loop structures, we can also hold our South African subsidiaries from it. And this entity can be held directly. So if it's privately held, it can be held directly or via a trust. And the trust basically protects you from a state duty and an exit charge if you're intending to emigrate. So when we're looking at privately held businesses, what the name of the game is essentially put as much as we can offshore in a jurisdiction with no exchange control, low taxes, and low withholding taxes on taxes in and out. And we lump whatever we can in that business, specifically things related to non-South African revenue streams and IP. Because IP is, as we said on the previous slide, that is the one really difficult thing to get outside of South Africa. Essentially, once you've got IP in South Africa, it's very hard to get it out from both an exchange control perspective and a tax perspective. And then in terms of holding it, it can be held directly by the South African resident or via a trust. And the benefits of a trust is that it protects the shareholder against a state duty, and it's outside of the asset base if the investor ever emigrates. It's absolutely critical to note that the offshore company needs to have substance. So it used to be possible up to about probably even 10 years ago, even more recently, to set up an entity in an offshore jurisdiction, basically as a post box and do nothing in it. But that is no longer possible. Now there are very, very tight anti-avoidance rules that essentially mean that tax benefits can only be achieved in having an international structure if you really do have an international structure. And that means the offshore entity needs to have significant substance. Okay, so then in terms of a diagram of what this would typically look like, what we would say is keep your South African structure as it is. So render unto Caesar those that are Caesar's, and everything else get offshore. So we leave in South Africa what we have to leave in South Africa. And so in this example, we have a South African company with its South African subs. If you're subject to BE requirements, you might have your BE partner on that side. And then essentially all of those entities will be paying 28% tax and 20% dividends withholding tax and flows up to the shareholders. And as I said, that 20% withholding tax will apply whether the shareholders own directly or via another South African company or via a South African trust. Then the offshore structure is in parallel to it, and many startups start with a parallel structure and only afterwards think about putting it all together under one global holding company, which ideally would not be a South African parent. So the offshore structure, in this example, we have offshore co, and we've chosen a nice jurisdiction with low tax, good withholding tax rates, a good regime to hold our IP. The offshore subsidiaries are underneath that. There's going to be minimal dividends, withholding tax and flows between them because we've chosen our offshore company with good double taxation treaties. And then dividends will flow up to the offshore trust or directly to the South African resident shareholders. So that's broadly what we would recommend. Having two structures, one in South Africa, and we keep there whatever is intrinsically linked to South Africa, and we keep our BEE play there. And then we have the offshore structure, which is where the growth will occur, the IP will sit, all of the non-South African revenues will roll up. And then services can be rendered between the two. And typically what we try to do, if the facts support that, is to actually position the high value adding services offshore so that in South Africa, the profits that would roll up would be relatively small. So for instance, South Africa could keep doing the back office type functions that rely on good skilled resources at low cost, but the brains of the operation would be sitting offshore, which then means that essentially a greater portion of the revenues can roll up offshore with all of the benefits we spoke to around currency exchange control and tax. Now, the question about IP. Can I move intellectual property from South Africa? The answer is yes, but. Or you could say no, but. It is very, very, very difficult to move intellectual property from South Africa. It is technically possible, but it is very difficult. If you want to sell your intellectual property to any connected person, and a connected person is any company in your group or any company owned by a trust of which you or anyone in your family is connected, the connected person definition is very, very broad. So if you want to sell your IP, let's say to your offshore company, you will need to get South African exchange control approval. And it is extremely difficult to get, and it takes a very long time. You also, to do that, have to ensure that you're selling the IP at market value. And of course, the whole question of how do you value IP, I mean, you could write a doctoral thesis on that. It is very, very difficult. Clearly, it would be in the interest of the Reserve Bank and the South African tax authorities to argue the value is as high as possible so that you end up paying South African CGT on the sale. Apart from valuing the IP very complex, it's also very complex to determine if the IP exists or where it exists, especially in a startup. And it's important to note that the concept of intellectual property for tax is not the same as the concept of intellectual property for accounting, and it is also not the same for legal purposes or for exchange control. So the whole question of what is IP, where is it, how much is it worth, is an extremely complicated, subjective area. It's important to note that in recent years, this DEMPI concept has come in, which makes it harder to argue that your IP is sitting in a low tax jurisdiction and tax optimized in terms of earning royalty income that is subject to a low tax, because the DEMPI concept says that the IP resides where it is developed, enhanced, maintained, protected, and exploited. So it means where all of the people who actually work with developing and using and adding to the IP actually sit. So it used to be you could just park your IP over in the Netherlands and the Netherlands would charge royalties on it and roll up your income tax-free. It is much more difficult to do that nowadays. And that's also linked to the transfer pricing around intellectual property is extremely complex. So the main point I want to get across here is if you have significant IP or you think your business will have significant IP, you need to plan it carefully upfront. The benefit in a startup situation is that often it's not clear if IP exists or when or how it came into being or where it is. And that can give us an opportunity, if we're able to structure it correctly, to ensure that the IP actually comes into being in a jurisdiction where we want it to come into being, which would not be South Africa. So the earlier it is in the pipeline, the easier it is to structure IP in a beneficial way, i.e. outside of South Africa. And the more IP is, the more documentation there is around IP, the more difficult it is to move it outside of South Africa. So the further along in the process, it's harder to move, particularly if you want to move it to a connected person, which obviously we would want to, because if it's valuable IP, we would want to maintain ownership of it. Or else if it's valuable and we're selling it to a third party, that would be fully taxable in South Africa unless we can first structure it outside of the country. So bottom line is, if you think you've got important, valuable IP that's going to increase in value, think about structure sooner rather than later. What can go wrong in terms of your structure? A lot can go wrong. South Africa has a very, very sophisticated and very aggressive tax regime, and they are very focused on South African businesses or persons who are trying to shift profits outside of the country. And there's many different ways in which SARS will try to attack this. This is the page of, I call it the acronyms from hell. So when you start operating internationally, the international tax framework that you have to consider is extremely complex, and it is a very aggressive area. So the main risks are what we call place effective management, or POEM. So if we set up an offshore company, and we said if we set up an offshore company, we put all our non-South African revenues in there, we put our IP in there, it all grows in value, tax optimized, there's low tax there and low tax all the way through. However, if that offshore company can be regarded as effectively managed from South Africa, i.e. if it's run from South Africa, then it will be deemed to be South African tax resident, and all of the structuring that you put in place has been a waste of time. So that is the biggest risk. And since we've been here in Mauritius, and I moved to Mauritius 3 years ago to set up the Regan van Roy office here, we have seen a lot of startups who have made this mistake. They go to a management company, they pay $15,000, they set up an offshore company, put contracts in place so the IP is there, but then it is challenged by SARS, and it turns out that nothing actually happens in Mauritius, everything happens in South Africa. So SARS is very easily able to argue that the place of effective management is in South Africa, and therefore the entire offshore entity is treated as a South African tax resident. So that risk has to be carefully managed. The next one is the permanent establishment. If the business is managed from overseas, but it's got people doing something in South Africa, i.e. the founders or the other workers are doing something for it in South Africa, that can be seen as having a branch in South Africa, and then we're obliged to calculate the profits allocated to that branch, and it of course becomes subject to South African tax. The next one is controlled foreign company. If South African residents own more than 50% of a foreign company, that foreign company is what we call a controlled foreign company, or a CFC, and can be subject to tax in South Africa unless a specific exemption is met. Again, we've come across lots of businesses who quite gleefully set up foreign entities, never knew that it would be subject to South African compliance requirements, and now have many years of tax to catch up on in South Africa. The next one is transfer pricing, which is quite overarching, and that all that says is that all transactions between connected parties must be at arm's length, and you must prove they're at arm's length, which means if you set up a company offshore and it's doing something for your South African business, or your South African business is doing something for the offshore co, you have to be able to demonstrate to SARS that that is priced correctly. In the old days, people would set up offshore co and basically charge it. It would earn very high margins and pay very low expenses so that the most of the profits sat there. That is no longer possible under transfer pricing rules. And transfer pricing is an area that SARS is, and actually every tax authority globally is very focused on at the moment. So it's critical that all of your transactions between connected parties are done at arm's length. The next one is what we call the GAR, the General Anti-Avoidance Regulations. There is a lovely piece of legislation in South Africa and in most other countries that basically says, even if what you're doing is legal in terms of the tax bill, if we think you're doing it primarily for tax reasons, to pay less tax or pay tax later, we're going to look through it and charge you tax as though you hadn't done it. So if we set up an offshore company and make sure it's properly managed overseas, make sure it's not a taxable control fund company, make sure the transfer pricing is correct, if SARS can then, if they're able to argue that we set up that offshore company purely to reduce our tax, they're able to ignore the fact that the company is offshore. And the tricky thing here is that the burden of proof is on the taxpayer. So SARS doesn't have to prove that we did something primarily for tax avoidance purposes. We have to prove that we didn't do it primarily for tax avoidance purposes. So it's one to be very careful about, as is the next one. So there's certain transactions that SARS views as intrinsically aggressive, and these type of transactions, which are share buybacks, certain types of distribution to a trust, certain types of services, that they must be reported to the South African revenue. That's probably less relevant for startups, but if you have someone that's trying to sell you a tax scheme, it's worth considering whether it could be a reportable arrangement. So that's kind of what can go wrong. I'm just looking at the time. This is how the place of effective management risk works. So South African company is in South Africa. We've got offshore company in, let's call it Mauritius. In theory, South Africa can only tax SA, offshore jurisdiction can tax offshore co. But as we said on the previous slide, if South Africa can argue that the offshore company is actually managed from South Africa, then the entire offshore co profits can be subject to tax in South Africa. So the taxing nexus spreads. And as you can see, then South Africa is also able to tax offshore co. So that's very important to ensure is done correctly, that all of your offshore entities are regarded as effectively managed in the jurisdiction in which they were set up. The next one is this permanent establishment or a taxable branch. So here's where we've got the offshore co. Okay, SARS is comfortable, it's effectively managed offshore, but it's got people doing something for it in South Africa. That means it could have created a permanent establishment, which is essentially a branch in South Africa. And then the circle that is that PE and all the profits attributable to that. And obviously they have to be calculated on arm's length terms under transfer pricing law, are subject to tax in South Africa. So then it's not as bad as the first one. Some of our profits still remain offshore, but a good chunk of them can be taxed in South Africa. The next one is control foreign company. So if the South African company has more than 50% of the shares or voting rights or economic rights, it's very broad in the offshore company, then again, the offshore company can be fully subject to tax in the hands of the South African resident parent in South Africa. And transfer pricing, all that means is where we have transactions between the entities and they're connected, even if the offshore entity is held by a trust, they will still be connected if beneficiaries of the trust are connected to shareholders of the other entities, then all the transactions that happen between the entities must be demonstrably at arm's length terms. So it's very important, especially for startups and especially for a business that has not yet operated outside of South Africa, it's very important to be aware of the complexity of the tax risks that can arise. Now, so that was kind of the bad news. Now we look at when should we think about setting up the structure. Now, in theory, the sooner the better, especially if IP is involved, and that's what we said on the IP slide. Once IP is given birth to in South Africa, it's very, very difficult to get it out of South Africa, and thus it will always be subject to tax in South Africa. It will also have to charge an arm's length royalty because of transfer pricing rules, which will subject to be taxed in South Africa, and it's going to be within the South African exchange control net forever. So in theory, if you have IP, if you have IP, it's better to structure sooner rather than later. In practice, however, and especially for startups, we say that it is better to structure slightly too late because it is expensive to set up an offshore structure and a lot can go wrong, as we've seen in the last few slides. And the real cost of setting up an offshore structure is if things go wrong, and you can end up in a years-long battle with SARS where you end up losing your shirt. So it's essentially a cost-benefit analysis, and it depends on how successful you think your business will be, because that will dictate how big the benefits, including the tax saving, are going to be. But we recommend caution, especially for startups who tend to be small groups of people and fairly volatile. And, you know, obviously some do extremely well, but some can also fail. And therefore, on a practical level, we say, don't set up your structure until you're really ready to commit the cost and the time to do it correctly. So structures are expensive to run, more expensive to unwind if they're not fit for purpose, and they require people in the offshore location. But a lot of people say, okay, but when should I do it? I do believe my business is going to be massively successful. I do believe we're going to have big IP. We would say a good time is when you expect to have substantial non-South African revenues. So if you're about to sign a massive client in the US, it would be a good idea to think about structuring that before that comes into play. Or if you expect to develop significant IP. So if you have an idea and you really think this IP is going to be very valuable, then it is definitely worth investing in the time so that investing in the cost so that it is structured safely offshore. And also, if you have some people offshore, so a number of startups, especially with COVID and the growth in remote working, a number of them say, oh yeah, my senior developer actually lives in Mauritius, or my senior IT guy moved to London last year. Those type of factors can be used to build an international structure around in a way that reduces costs, because the biggest cost, as we've said, is when your structure goes wrong. And the easiest way for it to go wrong is if you don't have enough substance in the other jurisdiction. So if you already have people in other jurisdictions, it is worth thinking about building a structure around those people. And only if you've got some non-South African stuff. So either you have got big IP that you think is going to be valuable, or you're going to have big IP soon, or you have big non-South African revenues. Now, the next question is where, and I see we had a comment earlier about all of the changes now with the global minimum tax rate and the the BEPS initiatives. So where is a key question, and it depends on the business in question. So it depends where the following are at the moment and where you expect them to be in future. The first one is founders and key employees. So where are they now? Where might they be? The second one is other shareholders, because we need to plan. First of all, if employees are overseas, we can use that to think around ensuring we have substance in the right jurisdiction. But also, wherever your shareholders are resident, we need to ensure that the jurisdiction we choose will work for them to receive their dividends or sell their shares in while optimizing tax. We also need to look at where your resources are, including your suppliers and your staff. Where are you expecting to get funding or potential investors from, and what country would they be from? And most importantly, where are your customers going to be? So once you can answer those, then it starts to become clear which of the jurisdictions are worth considering. We also need to think about whether you need a specific legal regime. So if you have proper IP, that you're going to have to go and sue people about, that you're going to have to legally protect. You want to set it up in a jurisdiction that's got a very strong legal system to protect IP. You might need a legal system that's got specific frameworks around fintech, or for instance, something like gambling. There are rules that have, there are countries that have more favorable legislative environments for fintech, for gambling, for cryptocurrency, which is a big thing. So we need to think about, is there anything regulatory or legal we need from the jurisdiction we choose? You also need to think practically. You want to think about the language of operation, the time zone, and how easy is it to get there? What is the reputation of the jurisdiction? And that's very important in terms of your clients and also your potential investors and funders. There's no point in setting up a company in, let's say, Iran if you want to have anything to do with the US. And you also need to think about how good is the legal structure there, how good is the banking infrastructure. On a practical level, can I do business there or not? Is it going to fit into what I want to do operationally? And then we do need to think about the larger framework of what is happening in the world at the moment with the drive to a global minimum tax rate and the move to basically shut down 0% tax regimes. So then this is more detail about, okay, but where do we go? So as we said before, we want to set up an offshore jurisdiction, an offshore company in a jurisdiction where there's no exchange control. I can work in hard currency. I don't pay a lot of tax on what I earn in country. I don't suffer withholding tax on flows into the country, and there isn't withholding tax on flows out. And if I sell my shares, I don't have to pay tax on them. And I also want to make sure that the jurisdiction is not on anyone's blacklist or grey list or any of these other lists put together by the various global oversight bodies that are important in this day and age. It's important to look at the double taxation agreements that jurisdictions have in place. A double taxation agreement is a bilateral treaty between two countries that essentially makes it easier to trade between them from a tax perspective. And in particular, it reduces withholding tax on flows between the countries. So if we know we're going to have customers in Africa, then we need to think about what countries have good double taxation agreements with Africa so that withholding tax on those flows will be as low as possible. And if we know our shareholders are going to be in China and America and South Africa, we need to choose a good jurisdiction, a jurisdiction that's good double taxation agreements with those jurisdictions so that the withholding tax on flows out is also low. So then the next one is, but more or less where? So we know there's no one size fits all jurisdiction that works for everyone, but what are the types of jurisdictions we can think about? So Mauritius is top of the list in this context because it is basically it's probably the cheapest offshore jurisdiction, and it works very well for South Africans. It also works very well for Africa. It also has gone to great efforts to get off all of the various grey lists and blacklists and all of that over the last few years. The next is the UAE, which also works very well for Africa. It's got good treaty network with African countries and a 0% tax rate for both companies and individuals. We do have some concerns around that with the global minimum tax rate and the BEPS movement, because they're clearly gunning for anyone that's got a 0% tax rate. So we do expect that to change over the next few years, but it still works well for now. Then there's also Cyprus and Malta, which are good alternatives, both in the EU, both very favorable tax regimes. Cyprus can be quite good for IP, and Cyprus can be good for going into the US. Delaware LLC, if you're doing a lot of business in the US, a lot of people like to set up a Delaware LLC, which is a very straightforward way to get your foot into America. Channel Islands, that's Jersey, Guernsey, the Isle of Man. They're kind of similar to Mauritius or the UAE, typically don't have as good treaties with African countries, including South Africa, and they typically are significantly more expensive than Mauritius, but also worth considering, particularly if maybe you're planning on moving to Europe or you've got a big focus in Europe. So all of those are what we might call typical offshore jurisdictions. So jurisdictions that build themselves as being attractive for businesses to offshore operations in. The next three are ones that are more what we would think of as onshore. So it's like proper jurisdictions where you pay more tax, but it's cheaper to set up in, and there are very beneficial regimes for certain types of activities. So that's Ireland, the UK, and the Netherlands. Ireland has the lowest tax rate in Europe at 12.5%, but very high personal income tax rates, does have excellent treaties. The UK is very good in lots of ways, slightly less so since it left the EU. It is on a 19% tax rate, was intending to drop down to 17%, but has now announced it is going to increase to 25%, which probably makes it less attractive. The Netherlands also 20% tax rate, but very good IP regimes. So each of these three countries have very attractive IP regimes. If you do have meaningful IP and you're going to be conducting R&D activities, you can essentially, depending on the circumstances, you can have that operation tax-free in either Ireland, UK, or the Netherlands if you fall within the specific regime. Then there's also Hong Kong and Singapore, which are can be relevant, particularly if you've got a lot of transactions in the East. And then a long way down at the end of the list are kind of the old bad boys of the kind of tax haven style, which are Seychelles, the BVI, Cayman, and Panama, all kind of 0% tax regimes. With the global changes over the last few years in terms of global minimum tax rate and the crackdown on so-called tax havens, these guys have a less good reputation and are under increasing pressure from the global oversight bodies, which links to the reputation. So it's not that they shouldn't be considered, but they often are not appropriate, especially if you're looking to be bought out at some time or you're looking for funding. It can be harder to achieve that in these type of jurisdictions. And we do think that many of them are going to have significant changes to their tax regimes, because they will basically be put under pressure until they do. Okay, so we basically have looked at now what type of company should internationalize. Anyone either with big IP or with lots of stuff happening outside of South Africa. What should we do? We set up an offshore structure and we push everything into it that we can that isn't intrinsically linked to South Africa, provided we can have enough substance there to justify it. Where should we set up? Well, it depends essentially on where your clients are, your shareholders, your staff, and what you're looking to do with the business long term. And now we look at how much does it cost to set up. So there is a difference between the kind of offshore jurisdictions like Mauritius, Hong Kong, Singapore, Cyprus, Malta, where the economies are sort of largely built around attracting businesses to go in there and set up shop there. They're typically expensive to set up in, the Channel Islands as well, obviously on that list. Mauritius is generally the cheapest, far cheaper than Cyprus, Malta, Channel Islands, Dubai, but it's still about $12,000 a year to set up a company in. So it's not pocket change. You can set up a company in South Africa, you can set up an SAPTY for like what, 400 Rand on SIPC, takes 5 minutes. It is not like that when you're setting up an offshore entity in an offshore jurisdiction. The non-finance center jurisdiction, so the countries that aren't really selling themselves as a place to attract you to come in and put boots on the ground to improve your tax, and that's kind of the UK, Ireland, Netherlands, they're much cheaper to set up in. But you know, obviously the tax benefits can be less. You also need to factor in your travel costs. You're going to have to go there often, certainly for your board meetings. So you need to think about how easy it is to get there and how expensive it is to set up there. And you should not forget the cost of management. So management has to spend a lot of time setting up the business offshore, and it's more complex to run a business in 2 different jurisdictions. So there is a real cost in that. And as we've said before, the real cost is when it goes wrong. Now, we are nearly at the end, and because I want to allow some time for questions. So basically, what's next? I think what every startup needs to do is to think about, should I structure or not? And if you have a lot of offshore clients, or some of your key people are intending to move offshore, or you have big IP, or you want to be sold one day, it is definitely worth considering an international structure. It's not necessarily the right time for every startup at the moment. You have to think of it in a cost-benefit way. What is how realistic am I about the success of my business? Therefore, how big is the tax saving that I think I can achieve? and use that to determine the right time to actually push the button and incur the costs in setting up the structure. But what we generally recommend businesses to do is at least develop a roadmap of when their offshore revenues get to this amount, or when the IP gets to the stage where it can be brought into being, this is the structure we will aim for, so that we are, every time we transact, we are building another brick in the wall that's in the right place. So we want to have a blueprint for what we want the group structure to look at, and know what we must not do to put that plan at risk, and know what we should do to ensure that we're building in the right direction. So that's what we call the roadmap of what to do and what not to do to support the narrative we're building around the ultimate international structure. And then you identify specific triggers. So when my overseas revenues get to 10 million rand, that's when I will start structuring. Or when I'm about to do a deal that's outside of South Africa and is over X million of rand, that's when I'm going to start considering it. And it is critical to get good advice up front. I hope it's been clear from the slides on what can go wrong, that a lot can go wrong. We often talk about unscrambling the egg. People who rush into a structure can often have a huge cost in trying to sort it out later. And so it is worth really looking at it carefully up front. We have a special offer for the rest of 2021 only for startups. So we have a very discounted price in terms of a structuring workshop. So what we do is we send a questionnaire to be completed beforehand with some key information on your business, the shareholders, the location of your clients, IP history, all of those, all of the relevant factors. And then we do a fast track structuring workshop where we go through exactly what your roadmap should look like, and identify essentially the framework that will work for your business in terms of its structure, and the clear don't ever do these things list. Make sure you're doing this, and contact us if any of these things happen. If you would like to book that, please contact us. My contact slides are here. My contact details are on the last page. I'm going to now stop sharing so I can go into the questions. Why is Canada not on the list? So obviously we could have, we could have had hundreds of companies on that list. We looked at typical offshore jurisdictions, and Canada is not one that we would, Canada isn't a particularly beneficial tax rate. It's not particularly good for South Africa. So yes, they're not the only jurisdictions that we cover. We have to understand from the specific fact pattern of each company's own position what the appropriate jurisdiction would be. Other questions: I don't have a proper structure set up offshore, but I do have a Delaware LLC, and I've started developing some IP aimed at the US market. How do I make sure the IP is set up there? Yes, I mean, that is something that is there's no simple answer to. I think the bigger question is, do I want the IP to be in the US? So just because we don't want it in South Africa doesn't necessarily mean we want it in the US. I would suggest you look at what the IP is, how valuable you really expect it to be, how big an impact in your business, and then come up with a proper plan as to how to bring the IP into being. And I would be surprised if you want to bring it into being in the US. Okay, then we have some other questions. I imagine that the new proposed framework for global tax may have an impact on the choice of jurisdiction down the line. Yes, that is something that is important, and that is what we think of as the reputation of a country. So it's worth looking at what countries are seen as kind of not playing ball at the moment and are likely to be investigated further. And it is clear that there is more and more a gap between the kind of good guy tax havens, and that's like Mauritius and Singapore and Ireland, who are doing their best to remain on the right side of the global oversight bodies. And then there's the other guys like the Seychelles and BVI and the Cayman, who are just saying, we don't care, we're going to keep charging low tax. But in our view, it will become more and more difficult to transact with those entities, and particularly if you're looking to be bought out at some point, it is worth considering the reputational impact of setting up in those type of jurisdictions. Botswana, yeah, Botswana is an interesting place. It's got a couple of attractive regimes, but it depends what you're doing. Botswana can work well if you're mainly focused on into Africa. If you're focusing on growing your business more globally, I typically wouldn't recommend Botswana as a long-term structure. Would you advise a similar strategy for an SA company exporting products? Yes, no, for sure. If you're exporting products abroad, there's no point in, or there's ways to structure it so that you're not paying South African tax on the entire value chain there. So yes, the IP, the only difference with IP really is that you have to do sooner rather than later because of the added exchange control issue. But certainly any business that is operating in the non-South African market, including exports of goods, is worth looking at a way to improve the structure. Can contractors for non-South African companies structure in a way to gain any benefits? Yes, but it's very difficult. So if you're in South Africa and you're consulting to or contracting for a non-South African company, a lot of people think they can just not pay any tax. It's not simple. There's a lot of anti-avoidance rules to ensure that personal services are taxed if you're doing them from South Africa. So anything is possible, but that is quite an aggressive way. There's some quite aggressive anti-avoidance legislation to stop that. Could you use structuring as a way for the owner directors of a services company to move to another country? Yes, absolutely. Especially for startups, if you have non-South African customers, then if the founders move to another country, the brains of the business and thus the main revenue generators are moving to the other country. So that is a very easy way of doing a structure, because as I hope I've made clear, the biggest risk with the structure is if you don't have substance in the overseas jurisdiction. So if you've got senior people, i.e. the owners or directors or founders, moving to an offshore jurisdiction, especially if it's somewhere where you would want, that has the benefits we spoke about in terms of exchange control, low tax rates, that's a very easy way to build a structure offshore. The issue is when you move, there can be an exit charge. Either if you emigrate, if you tax emigrate, there's an exit charge on the value of your shares. And if you move a business, there can be an exit charge. So there's ways around it that need to be carefully considered. But certainly, if the founders are going to move anyway, there's a lot of scope for structuring the business around that. There's a few more questions here. So is there no way to dissolve the business and completely sell the entire IP to an offshore company that you have shares? Yes, but it still is a sale of IP or a company with IP in it to a foreign entity. And the same issues would apply. You have to get SARB approval and you have to value the company, and you have to pay South African CGT, whether it's on the IP itself or on the company in which the IP sits. It's essentially the same issue. It's just a slightly different way of doing it. Yes, I agree. Canada is very good for tax credits, hiring staff, and it has a favorable corporate tax rate for low profit. So yes, Canada is a nice jurisdiction, especially for founders who want to move to Canada. But it's not something that typically works well if we have a business that's running in South Africa that still wants to use South Africa but expand globally. But I agree, Canada is, lots of things to recommend it. Okay, I think that is all our questions. You have my contact details here. So please don't hesitate to contact me if you would like to book a session to see how we can help you, or if you have any questions on today's presentation. Thank you all for attending and enjoy your afternoon.